could we just touch a bit more on sort of the risk levels taken within the matrix and how you've managed that process over the last 6 months with everything that's going on with COVID, etc., in terms of, ensuring that the solutions that we're offering are taking appropriate level of risk, and also that the performance we expect are within those boundaries.
Yeah, I mean that's a key point, and it's something that's so fundamental to what we do. I sometimes forget to mention it because risk is almost all we think about. When we put anything on the matrix, the first concern almost is that the expectations your advisor sets with you in terms of what is the risk journey are going to be delivered by the solution. Well, what does that mean? It means that you have a discussion with an advisor, there's something that you want to achieve, and that can only be achieved if it requires a market return by taking a degree of market risk. So what does that degree look like? What can you expect in a good year? What can you expect in a bad year? What can you expect in those worst case scenarios that we seem to find ourselves in every 10 years? That they are going to happen. What can you expect on average throughout the whole journey? And so the risk grading of the matrix is designed to put some structure and discipline around that. If, for example, your advisor says that this investment is balanced, well, that word has a meaning. It's defined in a number of specific ways. It's defined by a typical asset allocation. It's defined by an expectation of volatility and an expectation of what loss might look like. Our fundamental belief is that there is no way to get a return over a risk-free return without taking risk. And that sounds trite, but you'd be amazed how many, let's say, less scrupulous advisors, and not to mention the man in the pub, like to present returns over cash as something that you can sometimes get without taking any risk. And you really can't. You have to invest with your eyes open, take risk, understand what that means, and then settle in for a journey. I've found over the years that the best advisors are the ones who admit what they don't know. If an advisor presents certainty to you, I know the market will do this, I know this fund will do this, I would always have a red flag in my mind about that. There are things that we can control and things that we do know, but there is an awful lot that we don't know and that we can't control. And so the risk around the matrix is just an attempt to frame that decision that you have to make in partnership with your advisor around how much risk you're willing to take in pursuit of your goals, and how that level of risk sits with your overall assets and your overall plans and your psychology actually as well. Part of being a successful investor is being able to sit tight when things aren't going so well, not to rip up your plans when you have a bad 6 months or a bad 12 months, but to make plans, to understand that there are going to be good and bad years, and then just to have the discipline and the confidence to sit tight. And that is not an easy thing to do. That's why we believe financial advice is an ongoing thing. It isn't a set up some plans and then leave them. We need advisors in our lives just to counsel us through the highs and the lows. Without advice, without assistance, people have habits they tend to fall into. They will panic sell. And we did some research a couple of years ago that shows that roughly 20% of investors will want to sell all of their holdings to cash on just a 10% market fall. Now, 10% market falls are common. They happen all the time. They shouldn't worry you when they do happen. If you go to cash, you just lock in your losses and cost yourself any chance of recovery and subsequent growth. The other thing that people tend to do without advice is chase returns. So rather than invest on a forward-looking basis, what do I think this thing is going to do? How does it fit with what I want to achieve? They try to buy history. Here is a fund that has done well, therefore I should buy it today. You should always challenge that thinking. Always ask yourself, what evidence do I have that the track record I can see is going to be repeated? Sometimes buying a thing that has done well just means you're buying something that's overvalued. It's run out of steam. Its days are over. Sometimes good performance repeats itself. Telling the difference is very, very difficult. And often professionals can't tell the difference. It's not easy.
How do you go about doing that, Rick?
Well, the key thing, and this brings me on to some of the points I was going to talk about. It's what people tend to do when they look at funds is just look at the outside, the track record, so a line on a chart, without understanding what is behind that line. What holdings gave rise to that performance? Are those holdings still present in the fund when we buy them today? What styles in the global economy and global markets were in force from point A to point B? Are they still in force? And a classic example of that right now, a lot of people are very, very interested in passive performance, because over the last 10 years, passives have generally outperformed actives. Not in every case, but in many cases. And that's fine. We offer passive investments, and they can be the right thing for many customers in many circumstances. But you have to understand what gave rise to that outperformance over the last 10 years, because it isn't magic, and it isn't necessarily a set of circumstances that's going to be repeated. To bring that to life, you might have heard the phrase FANGs. And FANGs is an acronym for large US listed technology stocks. Facebook, Apple, Amazon, Netflix, Google, and Microsoft gets thrown in there as well. They've been a key driver of returns in the US market over the last 10 years. In 2009, those stocks combined made up less than 5% of the S&P 500. So they were big and they were significant, but they weren't dominating that index. Today, they are something like 22% of the S&P 500. Okay, so that's a massive amount of growth. That is part of what accounts for the success of passive strategies in the last 10 years, is that you would automatically allocate and chase that position. But one of the things that we like to look at on a forward-looking basis is what's called implied growth rates. And an implied growth rate is just this. If a share price is at a given level today, what does it have to grow at over the next 10 years to justify that price? And the implied growth rate of some of those large US tech stocks right now over the next 10 years is in the range of 20% per year. In order to justify today's price, Netflix, for example, needs to grow at 19% a year for the next 10 years. Now, to put that in context, the average historic annualized growth rate of an S&P 500 stock is 5.2%. So in other words, those shares are only fairly priced today if they are going to grow at about 20% a year for the next decade. So we just need to challenge that. Do we think that's likely? Does that mean today we need to be buying them at their current prices? That's what you're doing if you go passive. So just always look behind the line and be thoughtful about what you're getting into. Okay.
That's
Where
great.
else? Yeah.
Yeah, Rick, maybe you could just finish on the sort of level of research and due diligence that you do to put together the matrix. I know it's incredibly extensive, and I think one of the things we were hoping today was to sort of show to our clients the work that's going on behind the scenes to get the solutions ready for them, if you like.
Yeah, sure. Okay, well, solutions get on the matrix in two different ways. Either we build them ourselves to do a specific job, and we do that with our partners in Quilter Investors, which are a multi-asset investment specialist who sit inside the Quilter Group. And with those solutions, we have the ability to tailor things to do specific jobs at defined levels of risks to meet things that we know our clients want. And then we can monitor and govern them to do that specific job. That's the first way we put things on the matrix. The second way is that we look at the whole market and ask ourselves what else is available. And we do that in a way which is small I, independent. Independent has a specific and controlled meaning in financial services. Independent with a big I is a regulatory status for an advisor. Independent with a small I is what I mean when I say we send our analysts, which are Morningstar and Square Mile. These are large independent fund analysis firms who work for us under contract. And we employ them both so that we're not overly dependent on one firm. We have two firms doing the same job in independent silos. Their job is to scour the whole UK market for multi-asset managed solutions that are suitable to sit on the matrix. We don't, as some other firms do, cut third-party deals. So nobody buys their way onto the matrix with promises of sort of either revenue shares or any of that sort of stuff. There are no commercial arrangements in place with any of these firms. They're only there because we think they're going to do a job at a defined level of risk for the long term. And we're entirely agnostic about who is on there. On the matrix, you have some of the largest asset managers in the world, such as Vanguard, such as BlackRock. You have some of the best known in the UK, such as Jupiter. You also have some very small firms like Cornelian, who have very little under management, but manage what they do manage very well. And some firms that are not household names, such as Perford. We don't care whether you're big, small, famous or not famous. We're interested in what are you doing, what are you holding in your portfolio, what do we know about the style of your management team, what do we know, most importantly, about the risk discipline of the team. So if we place a third-party solution on the matrix at dynamic, can we be as certain as possible that you'll get a dynamic level of risk? And that requires a lot of deep diving into the fund. And that's where we rely on Morningstar and Square Mile. We pay a fortune for their services, but I think given the number of clients who depend on the matrix, it's worth doing that. Brilliant.
Thanks, Rick. Aware of time, I think you've got to jump off, haven't you?
I've got another 5 minutes. It's actually at 10 o'clock, so very happy to take questions.
Fantastic. Yeah. So if anybody does have questions for Rick at this stage, please put an X in your chat box, and I'll come to you and I'll mute you. If not, I think perhaps if we could go to David here to explain a little bit more about how we work with the matrix and how that links up with Rick's job, and also then look back at what Rick and David were saying back in March and what has actually transpired since then, to see whether you guys were on the money or not.
Thanks, James. Yes, it was. I did have a wry smile when we were planning this, and James said, "Could you sort of put into context what you said 6 months ago and how well that panned out?" And I think, well, it's very easy to take short-term views of these things, and certainly in terms of what I was saying 6 months ago, the last 6 months has sort of proved me right. But that's a very short-term timescale, and actually, I'm pretty confident that the next few months are going to be just as volatile, if not more so, than we've experienced already this year. So everything is a snapshot in time when we're looking at past performance. As Rick was saying, it's very easy to look at what things have done. It's more important to look about what things are going to be doing. And certainly what we were trying to communicate, I think, and hopefully well, at the beginning of this year, when we started this pandemic and nobody knew what was going to be happening, was it's not about trying to make a quick buck. It's not about investing because things look cheap or things look like they're doing really well. It's all about having a plan and putting things into the context of that plan. And that's why we knew that we were comfortable that our clients who were already invested through us weren't going to be having problems because of these unexpected falls, because they all had plans that were for the longer term. And we had plans in place, which meant if something went wrong, which we knew it would, we just didn't know when, they had the money to mean that they could just wait out these falls and wait till things recovered. And as Rick was talking about, it's all about understanding risk and risk management. And the way that we operate in these things, I'll put that into context of some of the graphs I showed before and what's happened since in a minute. But the whole point of what we're trying to do is to understand what it is that our clients are trying to achieve. And then that gives us a number of different parameters, one of which is what they're starting with, the other which is what they want to get to, and then we've got the time scale. And from those three things, we can work out mathematically how much growth they need to get from where they are now to where they want to be. And that enables us to map it, as Rick was talking about, to a level of risk. How much risk do you need to take to achieve that amount of growth in a portfolio? And then we can start talking about how people are as individuals. Is that a level of risk that individual is going to be comfortable with? If they are, that's fine. If they're not, then we need to look at those other parameters and see, well, what can we change? Do we change
David, sorry to jump in. When you're talking about are they able to take that level of risk and that maps to a level of performance, just to bring Rick back in here. Rick, I think David will have spoken to all of our clients, or your other advisors on this call will have spoken to you about, if you take this level of risk, these are the expected returns. This is sort of the window. How have the funds that as you were talking about, that you narrow down to 65 odd funds, how have they performed within those parameters during this last 6 months, given it's been a pretty interesting time?
They've all been within parameters, as always, particularly with the active funds. Different managers have approached things in different ways, and that's why I always advocate picking a style, picking a manager, and sticking with them. Because if you try to jump from fund to fund based on short-term performance, more often than not, you get the worst of one and then the worst of the next. To bring that to life, I mean, if we just look at what our balanced category of risk that I've got up here, over the last 10 years, for those that have 10-year track records, the annualized returns are very, very, very similar. I mean, I've got our own Carillion balanced fund over the last 10 years annualized just over 6% a year. I've got another fund 6.14, another at 5.62, another at 5.36. So they're all within plus minus 1% of each other. And over time, returns tend to settle down to these very similar numbers. But you'll only get that if you stick with whatever fund you're in. Because if I just look at the Troy Trojan fund, for example, that's at balanced. And on the downturn up to March 23rd, when we were all panicking about COVID-19 far more than we seem to be now in market terms, it was the best performer on the downside. Actually, by some distance, it was the best at defending capital in that period. And because of that, unfortunately, some advisors moved clients proactively into that fund, thinking that they would therefore have better performance in the future. But actually, the same thing that gave it the best cushioning on the downside gave it the weakest recovery from 23rd of March to now. That fund is substantially behind other funds in the bounce back from 23rd of March to now. So you see what's happened there. If an advisor looked at that data point only, the better protection, and for that reason only moved a customer from another fund to the Troy Trojan fund, you're just getting the worst part of the style, if you like. All funds are going to be flattered or not flattered at different times in different market conditions. That's entirely normal. But they do tend to settle down over time to these fairly consistent long-term returns. Now, it's the same as I go up the risk scale. You know, if I look at our dynamic level of risk, those that have 10-year track records, not all do, I've got a 7.52 per year. I've got a 7.66 and I've got a 7.48, you know, just within a few basis points of each other. But in all of those cases, you have to buy it and stick with it.
Brilliant. Thanks, David. And that's what, knowing you well, that's what you do.
Yes, absolutely. And I think most clients who've been through a number of reviews, my position is if the objectives haven't changed, the timescale hasn't changed dramatically, and their attitude, approach and tolerance for investment risk hasn't changed, unless I've been informed that the investment strategy that we've been used itself has changed, then I stick with it, because, you know, if it's going to work, it's going to work. And I think it's something, just building on what Rick was saying, the thing that is really important to me, and certainly when James and I were deciding the right sort of setup for David James Wealth and how we wanted to be able to serve our clients, was that level of due diligence that goes into finding those funds, finding the right funds, and not just that bit, but carrying on looking at those funds and what they're doing and what they continue to do, is something that we couldn't find anywhere else. So it's absolutely essential to us and what we are able to do for our clients in terms of that understanding risk and having that confidence that we'll be informed if something changes. And I think that, putting it back into context, I think a lot of people worry when they don't have any experience of investing and they look at what markets are doing, you know, and it's very easy when things are doing really well to get excited about it. And it's also very easy, like at the beginning of this year, when things seem to be going completely in the wrong direction, to panic a bit too much. But actually, if for people to make money in real terms, you need to own what we would call real assets, you know, whether that be property or shares or whatever else it might be, because over the medium to long term, those are the only things that are going to have a chance to beat inflation. If we leave money sitting in cash, and we can see some charts later on, you will lose money in real terms because inflation is almost always, certainly over the medium to long term, higher than the rates of interest that you will get from a bank, even ones that are desperate for your cash. And I think this is important, but it's always about having the right blend. So you understand, how do you mix these things together to get the right level of risk for an individual? But in almost all of these portfolios, the good quality ones, even at the lower levels of risk, there'll be some exposure to international stocks and shares. And if you think about it, that's reasonable. Why would we want to stick ourselves in things that are in the UK? It's about having access to everything. And it's by having those things in the right proportions, managed by people who have a track record of demonstrating they know what they're doing, not relying on individuals, but big, robust teams of analysts and experienced managers to get these blends in the right way, that you get over the longer term, the returns. Now, I'm just going to share, what I'm actually going to start by sharing is the slides that I used 6 months ago, or back in April, it's not quite 6 months. And we're talking about, by talking about this concept of investing for the longer term. And this was a chart that I'd stolen shamelessly from Quilter Investors, which has sort of had some points about what's been happening, the ups and downs of markets, and showing that even with the ups and downs over the longer term, still real assets, the green line being global stocks and shares, the grey line being corporate bonds. That's when, rather than owning companies, you're lending them money. Significantly outperforming cash. And I put that into the context of various crashes that had happened over the years since sort of the stock markets went trading electronically back in the mid-1980s. And just starting with the first one, which is the stock market, the Black Monday crash of 1987, which we can see there, it started in October, back up to par by the end of the year.
David?
A slightly long... Yeah.
Sorry to interrupt. I just don't want to sign off without saying goodbye, but I do need to go to my next call.
Thanks, Rick.
Thanks all for listening, and enjoy the rest of the session.
Cheers,
Thanks
Rick.
very
Take
much.
care.
Cheers.
Thanks.
The longer one, stock market crash of the early noughties, 2002 to 2005. But actually, they were just the run-up that was following 9/11. But actually, 9/11 itself, very quick fall. But actually, markets picked up quite strongly before that. We then had the one which perhaps more of us remember, which is the global financial crisis. Again, took just under 2 years from the start of the fall to recovery. Then we have what happened after the Brexit vote. So this is, if you remember back June 2016, and the month after the Brexit vote, things were up quite strongly. World markets up 14% in a month. And this was the 3 years after Brexit, to basically where we were at that point. And then this was where we got to from the beginning of this year to the 6th of April, 7th of April, when we were last having one of these sessions. And all we knew at that point was nobody knew. The reason the markets have fallen off a cliff so quickly and remarkably quickly was nobody knew what the impact of the coronavirus would be. We just knew that global economies had been parked effectively, and everything was grinding to a halt. But I think the one thing that we said at that point is we don't know when it will recover, but at some point it will, because at some point we will get back to some form of normality. The economies will start up again. Whether that takes months or years, we don't know. But the point is, if you're investing properly, you don't react to these circumstances. You're investing against a plan. And those people who actually followed that and stuck to that, which fortunately was all of our clients, did quite well out of that. And I'll come to that in a second. And I finished up with this whole chart here, which just showed the power of staying in the market, just pointing out it's not about trying to time the market, it's about the time you spend in the market. And this was investing over 20 years, end of December 1999 to end of December 2019. So those 20-year period, if you put £10,000 into the market and you'd stayed in there all the way through, your £10,000 had become over £30,000. If you'd missed 25 days out of 20 years, there's nothing, 25 days only out of 25 years, all you got back was £11,500. And that was the big difference. So I was saying, stick with it. At some point, it's going to recover. What then happened? This is the bit that James wanted me to do, I think. So this is 3 different markets since the end of that last slide. So the blue line is the world market. And then we've got 2 UK markets. The green one is the FTSE 250, which is smaller UK companies. And the red line is the FTSE 100, which is the sort of thing that most people who know nothing about investing, when they stick their toe in the water, as it were, if they're not getting advice, they'll go for the FTSE 100 because everyone's heard of it. Most of what's in there is actually a lot of international investment. So I think with what we get there is not just the sort of the big sort of mining stocks, and now it's coming up to pharmaceutical companies are coming into that. It used to be travel companies, and like that level sort of fallen out recently. But you've also got that currency risk involved there. But anyone investing in the FTSE 100, as you can see, it's done okay, better than leaving it in cash, but nowhere near as well as other markets. Putting that in the context of the year as a whole, so you can see sort of joining those two graphs up, you can see it's actually the world market, which is why I think it's so important that we have as wide a range of investment options to our managers as possible. And what I look for when I'm seeking, not just off that matrix, but in the specialist cases where I have to go and do my research, is that access to as wide an investment market as possible. Already, we've seen that global market has recovered and is in positive territory, up 3% on the year. Okay, so I think that just sort of helps put things into context, and just sort of focusing just on the world market alone just makes it a little bit simpler. You see, scary times at the beginning of that, end of February to the middle of March, that significant fall of about 23-24%, but still has managed to recover. It's because markets are forward-looking instruments. Well, they're not looking at where we are now, they're looking at expectations. Now, you can see a little bit of a fallback at the end of that. The end of last week, if we think, as Rick was talking about the FANGs, now, a number of those, the share prices, in fact, all of them, the share prices fell back a little bit. And that's 5 stocks having a significant impact on global markets because they are still such a large level of the market, coupled with the fact that the dollar in which they're denominated was a little bit weaker at the end of, over the last few months. It started to strengthen again a little bit. But this is the point. It's not about just trying to follow a market blindly. It's about trying to work out what are the right things to be invested in. As Rick was saying at the beginning, are these things that you now want to be holding, or are they a little bit overpriced? And a proper team of analysts with active investment managers are able to make those sort of decisions. Now, things, though, still happen that we don't understand, and that's always going to be the case. You would have imagined yesterday, given that the news we'd had in the UK over the weekend about, it looked like the UK government is going to rip up the Brexit agreement. You had government ministers, even the Prime Minister, coming out saying, we are supremely comfortable with a no-deal Brexit. The sort of things that this time last year would have sent the market into free fall and panic and everything else. Well, what happened with the FTSE 100 yesterday? It went up in one day by 2.39% on the back of all that news. Why is that? It's because it's not the only thing that they're reacting to. There's partially actually maybe the market's thinking, you know what, something's going to happen, it's all going to be okay. But there are a lot of other things that are happening. Markets go up, markets go down, they react. This is the point. We are not trying to judge what's going to be happening with these things. We're not trying to judge day by day what is going to be going on. We are just trying to say, for the goal that you as an individual, you as a company, you as a group are trying to achieve over that time scale, you need to get this sort of level of return on average. And to do that, this is the level of risk you need to take. Is that something with which you're comfortable? If it is, that's fine. If it isn't, okay. What do we need to change now to mean that you will have a comfortable journey and achieve something which is achievable, rather than 2 days before you need to retire or buy your holiday home or go, whatever it is that your objective was, having a shot because things didn't work out. It's all about that long-term plan. And when you look at things in the longer term, rather than the short-term strategy, you can see it does work out. If you leave your money sitting in cash, this is the last 10 years. Cash has averaged, this is not an average annual return, this is total returns. Cash has gone up by 9% over 10 years. So if you put money in cash over 10 years, you would have made 9% on it. The inflation over that period has been 21.5%. So you can see what I'm talking about in losing. The two in the middle, the red smoother line is property average. The is sort of what used to be called the balanced managed sector, now known as mixed investment, a range of 40 to 85% shares. It's where the majority of people in the market as a whole end up, especially those people who aren't advised or just sort of taking some advice. It's not where most of our clients end up because our clients end up where they should be, whatever that might be, whether it's balanced or aggressive or dynamic or cautious, whatever it is. But the majority of the market as a whole is in something like that. And even there, they've made a lot more money than just leaving it in cash. You start to factor in world markets into that, and you see there 200% growth over 10 years. That's where these added bits of value can get, but you need to know that you can be in it for the whole of the journey. And putting that finally into context, if you look at the last 30 years, almost going back to that first slide, but a little bit longer, inflation and retail price index over the last 30 years, the cost of living has gone up by just under 130%. World markets over that period have gone up by 1,113%. That's, if you take into account inflation in real terms growth, that's an average of 8.35% a year. Now, I'm not saying that every client should be purely invested in the global market. They shouldn't. That's too much risk for the majority of people. But it just demonstrates by having the right sort of portfolio that is managed in the right way to the right level of risk, which is the thing that we can measure, then you are most likely to get the outcome that you require. And that's what we do. It's all about planning. And hopefully I've now teed up Mark quite nicely for talking about behavioral inputs and why planning is important. But back to you, James.
Yeah, thanks, David. That's brilliant. And we're going to introduce Mark Pataccio, who some of you might have heard from before, but he's a award-winning behavioral economist. And Mark was the first person I heard, at least, talking about creating your own new normal. And you must have been saying that back in February, Mark, and it's now, everybody says it now. So you are ahead of the curve now. I think what we're hoping today is that you can talk to people a little bit about the emotions they've felt over the last 6 months and hopefully come up with, so I've spoken to you about this already, but some of the things you think we're going to see as the furlough scheme ends in October. There's lots of unknowns. You've got the US elections in November, and how you think people are going to be reacting to that and their emotions.
Yeah, sure. So, I wish I tried to copyright the phrase "the new normal" and get a penny for every time I heard someone say it, but apparently I couldn't. So, but no, I think listening to David and listening to Rick, I think the thing that comes across always when I'm listening to investment experts is it seems to me, as a behavioural scientist, that there's always there were two dates on which you should have invested either 10 years ago or this morning. So I don't think there's anyone that when you ask, nearly everybody says, "Oh, I wish I'd started earlier. I wish I'd started investing 10 years ago." And if you haven't, then obviously the best thing to do is to start today, because there are always reasons not to invest, in the sense that there is always uncertainty. But as David has shown, that uncertainty is just part of everyday investment life. But to achieve what you need to achieve with your investments, you just have to start investing and stay in the market. I sometimes think that the best thing to do would be just to invest your money and then blindfold yourself for 10 years and then just see what happens later, and not worry about all the noise that goes on in between. Because the problem that we have as individuals is that when positions are framed, when the world is presented to us in a very negative way. So, for example, when it's all going to hell in a handcart because it could have been the financial crisis in 2008, it could be COVID. We're all risk avoiders. When the market's rushing ahead and everybody seems to be making lots of money out of certain types of stock, we suddenly then all become risk seekers. So actually, the way information is presented to us makes us very counter-cyclical. We are not a very good species. We're not wired well to invest. If you take the very starting point that we're not actually very good at parting with resources that we've got today for our future betterment, we'd rather spend it on cars or sweets or beer. And there is a reason for that. I think I've mentioned before that if we go right back to when we were hunter-gatherers, the worst thing that could have happened to us is that if we went out and made a kill, the worst thing that could have happened is if we lost that kill to another predator. So wired into our very DNA is the fact that we massively value what is right in front of us. So to part with that for something that might happen in the future is actually very difficult to do. But as David has shown, that is clearly what you need to do in order to achieve your long-term goals. So when we're talking about investment, I would say to everybody, look, uncertainty is part of everyday life. It's as simple as that. So we've been here in 2008. We've seen market volatility. We've seen market volatility through COVID. We'll see market volatility again. The key thing really is to have a purpose behind your investing and to understand what that purpose is. It could be school fees planning for your children. It could be buying a holiday home. It could be transitioning away from professional sport and giving yourself choices for your future life. Whatever it is, it's that time frame that you need to worry about, and not the fact that Robert Peston is scaring the hell out of you, on the 10 o'clock news, or the negative financial information that you're taking. Or that you're hearing. So it's actually to have that time frame, have that purpose, and basically just stay invested. As far as we've done a lot of work on the psychology of the pandemic. And as we said, we experienced the grief curve. And I think if you take yourselves back to March, when you probably heard that this thing was coming, we were all in denial. We're going, well, it's something that just happens in China. All right, it's in Europe, but it's not going to come here. And then when it did come here, and then when the state started basically imprisoning ourselves in our own homes, then there was that natural anger. It was going, hang on a minute, you can't tell me what to do. What's going on? There was this anger. Then as understanding, as you sort of started to understand the situation, you started bargaining. So it's okay, I'll stay locked down for 3 or 4 weeks on the basis that, things will get better after that. So you go through this denial, this anger, this bargaining. Then there's genuine sadness, where you actually see what's going on and people are losing their lives, and you see the work of frontline workers, and you sort of think to yourself, well, actually, this maybe, I am really in quite a fortunate position. And then it's in that acceptance of what is happening, that real acceptance. That's where all our power lies, because we understand what we can control and what we can't control. And that's where we started talking about creating the new normal for now. Exiting this is going to be far harder psychologically than entering it, because when we entered it, we all entered it in the same way. We all went through the same curve at roughly the same time. What's happening now is we're exiting it piecemeal. So there was a lot of anger amongst people about, well, hang on a minute, if my friends can play tennis, but we're not allowed to play cricket, or that hairdresser can open, but my nail bar can't open, and so you've got a lot of anger there. Now we're seeing a situation where you're getting regional lockdowns. And so this disparity starts occurring, and you're going to get more and more of that as we progress over the next few months, because we're all in the same storm, but we're all very much in different boats. And what's going to happen as we come out of this is we're going to see who's got the life jackets, because obviously when the furlough scheme finishes, we're going to see the different economic consequences for different people, and that's going to have an impact. And this is why it's so important to have an advisor in your corner, to have a competent financial advisor in your corner who can remove all the irrelevant noise that might affect your decision making and remind you of the purpose of why you're invested in the first place.
Brilliant. Thanks, Mark. Fantastic. Actually, as you were speaking, some of you might have read in the Financial Times this weekend, there was an article by Interactive Investor called The Great British Retirement Survey. They surveyed 10,000 people. What the number one thing that people wanted was peace of mind. So coming back to what you were just saying there, Mark, that's bang on the money. Interestingly, the biggest regret, Mark, you can probably guess what it was.
Not starting early enough.
Correct. Their biggest regret was not starting a pension sooner.
Yeah.
So yeah.
I think the problem as well is when we talk about peace of mind, people need to be very wary of where they're receiving their information. Now, I've got my own views about broadcasters and how they've dealt with the pandemic. I think there is a breed of journalists now that they want to be the news. They don't want to report it. They want to be in the headlines themselves, and this makes for some fairly extreme reporting. And what we've seen as well is in a lot of cases where reporters have looked for inconsistencies. They've looked for things that are confusing, where in fact that confusion has actually probably only affected a very small proportion of the population. It's very interesting where there's now research gone into some of the images that we used of people breaking social distancing, and actually these were very much the exception, and actually a lot of those images were pre-COVID. They weren't real images. So when we're being given information in this way, in an extreme way that's designed to make us react to the news possibly in a negative way, that doesn't help our mental psyche when it comes to things like investing and actually our own peace of mind. There have been, I've seen so much positive behavior through through COVID, the way communities have come together, the way I've seen people help each other, the way, like I said, that sense, that empathy and that understanding has been quite fantastic. And I sometimes think we should concentrate more on that than we should what's coming out of Sky News and BBC sometimes.
So Mark, just to sort of summarize, if you like, what would you say is your biggest word of advice to people as we head towards as what you've called a more difficult phase, potentially more difficult than going into lockdown?
I'd say keep stocks of goodwill, empathy, and kindness very much. Keep them very much stocked up, because I think we're going to need it. Try and understand where the sources of your information are coming from, and you're going, things that make you angry, which they do, try and understand the context in which you're feeling that emotion, and try and understand and actually look for the positive things that should actually make you feel very positive about the behaviours that you've seen you and your friends and family and community. You've seen the way that they behave as well. But the key thing when it comes to your investing is just listen to your advisor, because they will hopefully remove all this noise for you and remind you of why you've invested in the first place, and just view things over that time frame, not what's happening last week.
And is that what you found when you did your big research paper, the award-winning Advisor Delta, that actually it was that behaviour that was the biggest difference between advised?
Massively. Yeah. I mean, I understand, and a lot of your audience today will probably have different levels of interest in the technical side that Rick was talking about, for example. I get in my car, I switch the engine on, I don't really know what's going on under the bonnet, but what I want to know, do I enjoy driving it, and is it getting me to where I want to go? Those are the things that interest me. So I sort of take it for granted that the engine's going to work. I take it for granted that when I use my advisor, that the engine is fine. All the investment strategies that are in place are there. What I really need them for is that reassurance, and to take away all that noise, to prevent me from behaving in a way that my future self will come to regret. So we found that people did panic sell when things went down and crystallize their losses, because it was the equivalent of standing in front of a bear. It's fight, flight, or freeze. You just want it all to end. You just want to stop. But the other thing as well is that they then invested in the latest shiny thing. quite often after it had, massively rocketed in value. So it would have either been a stock or it would have been a cryptocurrency, and all the growth had already been there. So you were chasing past performance that was never going to be repeated. So it's having that strategy, listening to your advisor and just saying, look, just ignore all the noise, just stay invested on a journey that you're prepared to take. Remind yourself why you invested in the first place and bracket your view over the whole of that time frame.
Fantastic. Brilliant. Thanks, Mark. Really, really good. Unless anyone has any questions, as I said, please just put an X in the chat box and we'll come to you. I think we'll end with David. David, do you just want to summarize, bring together, if you can, sorry to put you on the spot, what Rick's been saying and what Mark then nicely summarized there with blended with people's emotions and how it is in the real world?
Well, yeah, I think it exactly as Mark says, it's taking the technical aspects that is the Rick's responsibility and his team's responsibility to go away and make sure he's got the right, to use your image, the right spark plugs, the right type of fuel and all the rest of it, so that the engine is going to run in the way that it's expected. And if we send it on a journey of 500 miles, it's going to get there without exploding. But it's also, I think, putting that into the context of why people are doing things. Yeah, it is fine to invest on a speculative basis with money that you can afford to lose, in the same way that it is perfectly fine to take a bet on the horses or a punt on who's going to kick the first goal in what minute of the game and that sort of stuff. All that sort of stuff is fine to do, but it is not financial planning. It is not creating a future for that individual. It's a bit of fun. And the point of what we do and what people should be doing, and the only way that individuals are going to have a chance to achieve what they need to achieve, is to have a plan and to work with that plan. And then, as Mark says, all the rest becomes noise. It's stuff that happens on the way, and we will help our clients, and as we have done for, in my case, probably far too many years. You're
still younger than the average advisor.
Really well.
David.
I know, that's scary, isn't it? Been in this industry for over 20 years and I'm still younger than the average, but there we go. But not to get too excited when things are doing really well, but also not to panic and change the strategy when things aren't doing well. Make sure you've got the right equipment, and that's our job, if you like, to make sure that everything that's there is best placed to give you the best probability of achieving the outcome that you need. But the most important thing is to have a plan and an understanding that it's going to work in a way with which you are going to be comfortable. Because if you're not, you aren't going to stick with it, and therefore there's no point in starting. So that's the most important thing. Understand what you're trying to achieve, understand what you need to do to achieve that, be confident that that's something that you are going to be comfortable doing, and then everything else will follow.
Fantastic. Thanks very much. Thanks, David. Thanks, Mark. And thanks, Rick, for joining us today. Thank you all for tuning in. We did record this, so if you want to listen to this again, drop us a line and we can send over the recording, and it'll be available for you to listen to the end, the start, the middle, all of it if you want. Stay in touch. Thanks for coming. Take care.